if you have a traditional IRA or a 401k, and let's say the balance is $500,000, the IRS might already think it owns $195,000 of it. So if you're within 5 years of retirement or just recently retired and have an IRA or a 401k, that could be your biggest or second biggest asset that you own besides your home. And, what society has taught you is that deferring taxes is the best plan. But what I'm going to show you is that could be a big disaster. And I'm going to show you the calculations that, really could shock you. This could help you increase your spending income in retirement, creating a bigger potential family legacy or giving you more money to spend to enjoy the future of your retirement years. And so the first thing is let's look at the IRS thought of ownership of your 401k and IRA. Imagine if you owned a business and you had a silent partner who doesn't do any work, takes no risk, and claims 25% or more of what your profits are, and also could increase what they feel is their fair share of the cut of the profit anytime that they wanted to. And you had little to no control over, when they did that in the future. And as your business got bigger, the more they wanted, meaning that's 25%. If it was worth 500,000, if your business grew to be worth $1 million, 25% obviously is double of what that happens to be. The question I ask you is, how fast would you want to get that silent business partner out of your business? And, if you own an IRA, you need to kind of start thinking about your IRA in the way the IRS thinks is exactly the same way as that silent partner. Your traditional IRA or your 401k, it's going to grow tax deferred with, smart investing, compound growth. But, every dollar of growth that you have in a traditional savings vehicle means that silent partner is going to get a bigger bite of that money as well. If your account doubles, their interest in the account could double as well, depending upon what tax rates are in the future. Also, if you look at tax rates and you look at the compound tax problem that we have, looking at like usdebtclock.org with our unfunded liabilities, the fact that Social Security is broke, Medicare is into trouble, and we've got all of these issues that are happening, it could be very possible that your tax rates could go higher in the future. So maybe, if you're in the 22% tax bracket, you could say in your personal situation, if you've been a saver and you've been successful at saving for the future, is it unrealistic for your tax rates to be 35% or higher in the future? In fact, if you look at the history of U.S. income tax brackets over time, what you would find is that the history of taxes have oftentimes been much higher. We hear this concept of tax just the rich more, but the question becomes, what is that definition of rich? And I think if you look at the history of taxes, you'll find that tax rates have historically been much higher for many people, not just what they call the rich. So here's what every successful saver needs to understand. You can't control when those future tax rates change, but what you can control is you can control the tax rates this year. And the question is are you going to let the government be the biggest beneficiary, or are you going to take action while you really still can? So here's what we need to do is you want to set up and develop a solution to detaxify your retirement account. What you want to do is you want to try to shift money from that tax deferred category and ultimately get it over into a situation where it's building more tax-free wealth. And then there's a couple of different ways that you could do that. If legacy planning was an important one, you could look at, life insurance as a vehicle to effectively pass on more of a legacy than a traditional 401k or an IRA. And the other one that I'm going to talk about is a Roth conversion. We're going to show you a couple of unique ways to do this. What I would say is that here at our office, we have retirement tax partners. Danny and the team that he works with of CPAs and enrolled agents can help kind of crunch the numbers. And if you're not working with retirement tax partners, I would say, first and foremost, I'm not a CPA, I'm not an accountant. You should always consult with your CPA or accountant, really before you make any changes of what you do with moving money from one category to another, because you don't want to get surprised and you don't want to find out that change could trigger something like unexpected higher healthcare cost or excess taxation on your Social Security. Most tax preparers that are out there, they don't really focus, in my opinion, on detaxifying retirement accounts. Most taxes and tax preparers out there, they do a really good job at trying to file accurate, on time tax returns for really what happened last year. But once they get done with that, then ultimately kind of they go back to a little bit of a slower season. Maybe they do bookkeeping for small businesses. Maybe they work on some of the expenses that they've done. But, one of the things that makes a Retirement Tax Partners here at America's Retirement Headquarters is unique is we've been running these what if solutions. So, of course, we focused on getting federal, state, and local taxes filed accurately on time. But after that April 15th deadline comes by, now we get together and we run these tax what if analysis. And I've got, some good scenarios on what I've been able to see on how to help people out and good examples of seeing some of these what if analysis come through after the time. So if you have somebody who prepares your taxes and you're not getting back together with them and you're not doing a what if analysis and you're not asking the question, what can I do to minimize the taxes that I pay and my family pays during the course of my lifetime, you could surprise yourself with how much excess taxes that you pay. And I think, in my opinion, the time becomes crucial. It doesn't matter to me whether you're a Republican or a Democrat, whether you love the big, beautiful bill or you think it's the worst thing ever. The reality is if you look at the unfunded liabilities, our nation and our national debt is now over $36.2 trillion. And we're paying $952 billion just in interest payments annually. So the math is simple. The trajectory is unsustainable, in my opinion, without reduction of spending, right? And are we seeing the government reduce spending? Not really, not in many cases. So the other possibility that you could have is higher taxes. And history would show that higher taxes could be there for you and your family in the future. And if tax rates are higher in the future, your traditional IRA, your 401k could also be taxed at a higher rate. Plus, in addition to that, if you're delaying taxes like a lot of people do, and then you wait until you're forced to with what is called required minimum distributions, even when you don't need the money, you're going to have little to no control over what those taxes are in your plan. So the bottom line is this, if you have a few years before the current administration, makes any dramatic changes, I think is what my opinion is. And again, regardless of the politics, waiting means that you're going to have probably less control, less decisions, and significantly pay more taxes in the future. And so you really want to act, I think, while you still have control and create a tax roadmap every single year. Let's look at a real life example of somebody we'll call John. So John started on a 10-year plan. So 10 years ago, his plan was to turn 75% of his retirement account into tax-free wealth. Also wanted to reduce what he might have for required minimum distributions. He wanted to increase his spendable income and have the opportunity to leave a bigger legacy. So when we look at John today, John is 65. His wife is also 65. They retired back in July of 2016. They had a total of $866,000 saved in retirement assets. And even though he was spending money to fund his retirement, thanks to the market growth that he's had over the last 10 years, he still has $855,000 built up. So he's been able to keep up with, managing his withdrawal rates, maintaining his balance over his first 10 years of his retirement time. But what he did is he started to be proactive and he started to plan ahead and started every year to systematically try to move money over into the tax-free category. And now he has over $210,000 in tax-free Roth IRA accounts. He got to this point by every year, again, running a tax what-if analysis and looking at strategic as well as tactical Roth conversions. Strategic means looking at what is the amount of money or the room that you have in your current tax bracket that you can take advantage of and do Roth conversions. A tactical means that you look at the market conditions and sometimes you be a little bit more aggressive while you believe the market's temporarily down and it has the ability to come back. So in his situation, good news is, right, he's got some money built up into that tax-free wealth category. The problem is he still has $500,000 left in those tax-deferred retirement accounts that the greedy IRS is just waiting to get some of that money when he takes required distributions. So what he wants to do is he wants to, again, have a coordinated plan. And by coordinated plan, I'm talking about thinking about, how are required minimum distributions going to work into the equation? What is going to be the impact of taking money out of retirement accounts on Medicare costs? How are the ways that maybe you can maximize the legacy that you leave if you're going to leave money beyond you and your wife for your children? There can be strategies to do that. If we looked at his 2024 tax return, John had adjusted gross income of about $85,053, taxable income of $51,853. So when we looked at the tax what-if analysis, what we could see is that there's a potential of a Roth conversion opportunity of about $36,000. So that would be the amount that he has before he reaches that next tax bracket. Again, bringing his total taxable income, if he did a $36,000 Roth conversion, to about $88,000. Ideally, it'd be good to pick investments that have, some great growth potential. It's also good to look at this when the markets are a little bit lower and a short-term basis. And the goal is, again, to, pay the taxes on doing the Roth conversions, allowing more money to grow tax-free in the future. He does have to, again, pay attention to some of the other impacts that it could have on things like Social Security. So again, another word of caution before you do this, make sure you look at talking with your tax preparer or professional and run that what if with a professional so you don't get surprised. And here's what John discovered, though, in his situation. If he continues to coordinate the conversion strategy over the next 10 years, he could have roughly 75% of his money into those tax-free Roth accounts. That means tax-free income for the rest of his lifetime, tax-free income for his wife if he passes away first. That could mean tax-free income for his children with the money that he has. He also has dramatically reduced required minimum distributions because the Roth doesn't have RMDs. And really, dependent upon what the tax code is in the future, he's got much more control over how much taxes he pays because he has the ability to decide, should I take money from my traditional tax-deferred retirement account or should I take more money from my tax-free accounts, depending upon what the administration's policy is with taxes as well. And then again, ultimately making his bigger beneficiary his family and not the IRS if there's money that's left over in the end. So if you look at this, now you've learned a little bit about how much the IRS thinks they own of your retirement accounts and why it's so crucial to begin coordinating detaxifying your retirement accounts and looking at it in that way to reduce the taxes. Now, in our upcoming segment, we're going to be talking about voluntary taxation and that most retirees think about it and don't realize that there are many situations. In fact, there's 4 tax traps that are catching retirees off guard when it comes to voluntary taxes. So we're going to teach you that in this next segment.